Hello everyone, welcome to my channel. I'm going to share some tips and insights on cross-border tax issues from time to time here on this channel. Today, I am going to talk about tax residency requirements for USA and Canada and how they affect your income tax obligations. This is a topic many people are confused about, especially if they have ties to both countries or they're traveling frequently across the border. This is probably one of my most asked questions. So first of all, what does it mean to be a tax resident of a country? That means that you're subject to the tax laws of that country. You need to report your worldwide income to that country's tax authority. So if you're a tax resident of Canada, you must file a Canadian income tax return and report all your income from all sources inside and outside Canada. If you're a non-resident of Canada, then you only need to pay tax on the types of income that you earn from Canada, like employment income or business or rental income. Now, how do you determine your tax residency status in Canada? Unlike the US, which has a clear-cut rule based on citizenship, Canada does not have a specific definition of residency in the Income Tax Act. Instead, it relies on a case-by-case analysis of a variety of factors that indicate your residential ties with Canada. So these factors include a home in Canada, the presence of your spouse or your common law partner in Canada, or your dependents living in Canada. And then secondary factors might include personal property, a car, your furniture, social ties like memberships in a church or a club or a recreational organization in Canada, economic ties like Canadian bank accounts, whether you hold a Canadian driver's license or you're able to maintain health insurance in a Canadian province or a territory. So the more ties you have in Canada, then the more likely you're considered to be a resident of Canada for tax purposes. Now, of course, there's some exceptions to the rule. If you leave Canada and you establish a permanent home in another country and you sever your ties with Canada, then you're considered an immigrant and you cease to be a resident of Canada. But if you establish residential ties in a country with a tax treaty with Canada, and you're considered a resident of that other country, then you might be considered a non-resident of Canada for tax purposes. So it's important to look at each treaty between Canada and the other country. Now let's look at the US side of things. So, like I mentioned earlier, the US has a different approach to determining tax residency. If you are a US citizen or a green card holder, you're automatically considered a US person for tax purposes, regardless of where you live or whether you're inside the US, outside the US. That means you must file a US income tax return every year, report your worldwide income to the IRS. Now, there are provisions that help you avoid double taxation on the same income. You can usually claim a foreign earned income exclusion or foreign tax credits on taxes being paid to other countries. Now, if you're not a US citizen and you're not a green card holder, then you apply another test called the substantial presence test to see if you're considered a U.S. resident for tax purposes. This is based on how many days you spend in the U.S. over a 3-year period. And it's a little bit complicated, but you're considered a U.S. resident for tax purposes if you're physically present in the U.S. for at least 31 days in the current calendar year and 183 days during the 3-year period, including the current year and the 2 preceding years on a weighted basis. So you use 1/3 of the days from the first preceding year. You use all the days from the current year, 1/3 of the days from the first preceding year. So like right now we're dealing with 2022 taxes. So all of your days you were in the US for 2022, 1/3 of the days you were in the US for 2021, and 1/6 of the days you were in the US in 2020. You add all of that up together, and if that's more than 183 days, then you meet the substantial presence test, and the IRS requires you to file a U.S. tax return. Now, there's another way to avoid being treated as a U.S. resident for tax purposes, even if you meet the substantial presence test. You can claim the benefits of the U.S.-Canada tax treaty, which will prevent double taxation, and that is the US-Canada tax treaty has a special provision called the tiebreaker rule, which helps you determine your tax residency if you have ties to both the countries. So The tiebreaker rule works like this. If you meet the requirements in Canada as a resident and you meet the requirements of the US as a resident, then you're deemed, then you have to figure out which country you're a resident of, because the tax treaty provides that you can never be a resident of both countries at the same time. So the tiebreaker rules say that you are the resident of the country where you have a permanent home available to you. Now, if you have a permanent home available to you in both countries, then you're a resident of the country where you have the closer personal and economic relationship. That's where we get into some of those tiebreaker things like where's your house, where is your spouse resident, where are your dependents, where's your habitual abode, and then you can get into nitty-gritty details like where is your, where do you have bank accounts, where do you have your driver's licenses, do you have a driver's license only in Canada or only in the US? You start weighing those factors and determine where your closest interest is. And then, if you still can't agree, then basically the CRA and the IRS have to agree on where you are a resident. And claiming these benefits is not automatic. You must notify both tax authorities of your position if things aren't clear. You have to notify the CRA and the IRS of what you're claiming to be, where you're claiming to be a resident. If you want to claim the treaty benefits, then you need to file on the US side, you'd file a form 8833, which tells the IRS that, I'm actually closer connected to Canada. On the Canadian side, you can file an NR 73, which actually then has to get reviewed by the CRA, and they will come back to you and tell you that, we agree with your assessment. We agree that you're no longer a resident of Canada. So as you can see, determining your residency in Canada and the US can be pretty complex, and it depends on many factors. So it's really important that you consult with a qualified tax professional who's familiar with the tax rules on both sides of the border and can help you fill your tax obligations in both countries. So I hope this was helpful and informative. If you enjoyed it, give me a thumbs up, subscribe to my channel for more videos on cross-border tax issues. Thank you for watching, and we'll see you next time.